If you've watched the PPS Solutions introductory video about the importance of the finance department, you already know that financial statements are the basic primary output of the accounting process. But what exactly are they, and why are they important? The financial statements give a picture of a company's current financial condition and the results of its operations for a specific period. They're basically a language that allows the reader to understand what the company has done and how healthy it is. Companies whose stock is publicly traded are required to have these statements audited and then file them with the Securities and Exchange Commission. But why is it important to produce these statements if you're not required to? Well, there are many reasons. First, properly presented financial reports will help you secure capital. They're required if you want to get money from a bank, investment company, or in some cases the government. Without them, you'll definitely have a hard time. They also help inform investors and owners about how the business is doing, improve vision into the company, especially over time by comparing the results of one period to another period. They can help benchmark when you compare them against others in your industry, and when you're getting ready to sell your company, it's particularly important to produce correct financial reporting showing the earnings, assets, and liabilities that will affect the valuation formula used to determine how much somebody will pay for your company. To be useful, financials must be issued in a timely manner. After all, what good is old data even if it is correct? They should be prepared by a qualified individual using generally accepted accounting principles, or GAAP. GAAP is a set of rules for booking transactions so that the financial results of your company are complete, consistent, standardized, and comparable with those of every other company and industry. Accounting uses GAAP to make your financial statements more analyzable, trusted, and audit-ready than those presented without GAAP. Now that we've addressed why they're important, let's look at exactly what they are and what each one does. The basic three financial reports are the balance sheet, income statement, and statement of cash flows. The balance sheet shows the business's financial position at a specific point in time. It lists out the company's assets, liabilities, and capital, or owner's equity. It's called the balance sheet because it balances. The total assets of the company must equal the liabilities and equity. Generally, assets are listed in order by how liquid they are, cash being at the top, and long-lived assets such as equipment down below. Liabilities are listed in the order they're due, payroll and current accounts being at the top, and longer-term debt down below. The balance sheet alone can immediately tell the reader whether the business has sufficient assets, such as cash, to meet its obligations, such as payables to vendors and outstanding loans. You can also easily see how much money or equity the owners currently have left in their business. The income statement shows the results of a company's operations for a specific period, normally a month, quarter, or year. Different industries may have nuances, but the general flow and some of the milestones along the way from top to bottom are always the same. Sales or revenue is at the top of the statement, with cost of goods or the direct cost of those sales right below. When you subtract the cost of goods from the revenue, you get gross margin. A company's gross margin is a key indicator and is also expressed as a percentage of those sales. Below margin, many other operating expenses are listed, such as rent, supplies, or any other charge related to running your business. The result on the bottom line is your earnings or net income. Many investment-minded readers may ask that you add back a couple of expenses, including interest, income taxes, depreciation, and amortization, to show your earnings before these items, called EBITDA or EBITDA. As with the balance sheet, columns can be used to show important changes from period to period and also look at expenses as a percentage of revenue. The last statement in our big three is the cash flow statement. It's less obvious in its use and some find it difficult to prepare, but basically it breaks down the sources and uses of your cash into groups of activities: operating, investing, and financing. Positive numbers in the schedule are sources of cash, and negative numbers are uses. For example, if you received cash for your sales revenue, you have a source of cash in your operating activities section. If you used that money to pay down long-term debt, this is a use of cash in your financing section. The cash balances reported on the schedule correlate to how much money you have in the bank at the beginning and ending of your reference period. Now that you know what the statements are and why they're important, we invite you to learn more about the power of finance in our other videos in this series. More than just GAAP financial reporting, a PPS Solutions fractional finance team can help your business grow by building a fractional finance team that matches the needs of your unique business. From CFOs who offer strategy and high-level planning, to analysts, accountants, and bookkeepers to take off the administrative burden, no matter what your top line is, PPS Solutions will make sure your bottom line is healthy by providing a cost-effective team at a consistent and economical monthly expense. Find out how we do this today by scheduling a 30-minute consultation with us at ppsfinance.com.